Soft U.S. jobs data, an AI spending surge, and rising geopolitical noise are all colliding in equities right now. Welcome to vTalkInsight, Equity Pulse Daily for July 6, 2026, where we connect the macro narrative to sector leadership and stock-level risks in real time. Let us start with how the latest labor and inflation numbers are reshaping the Federal Reserve outlook and, with it, the near-term risk backdrop for global equities. Equity markets are leaning back into a soft landing story. Recent U.S. jobs data came in weaker than expected, but the labor market still looks resilient enough to keep the economy expanding, which limits immediate downside risk for risk assets. Job growth slowed meaningfully in June, while unemployment edged lower, reinforcing the idea of a gradual cooling rather than a hard stop. That mix has prompted markets to scale back the odds of another near-term Fed hike, with the probability for this month dropping and some participants now pushing any move out toward year-end. At the same time, inflation pressures are easing. Softer oil prices have helped cool headline inflation, and together with weaker payrolls, they have encouraged a rate pause narrative. Front-end yields have drifted lower and the U.S. dollar has softened, providing an additional tailwind for global equities and commodities. This more dovish pricing comes as political scrutiny of the Fed intensifies. Donald Trump has openly favored lower rates and is looking to reshape the central bank, while the search for a new Atlanta Fed president appears biased toward candidates with corporate backgrounds who might lean more dovish. For now, market pricing is more accommodative than the stance many Fed officials have been signaling. That said, the macro risks have not gone away. Deglobalization threatens to raise production costs. AI-related capital spending is adding near-term inflation pressure, and any renewed disruption in the Strait of Hormuz could quickly push energy prices and inflation higher again. Yet volatility remains contained. The VIX has slipped back toward the mid-teens as the S&P 500 delivered back-to-back gains of close to 1% late last week. The upshot is an equity market that is pricing a benign path for growth and inflation, even though the range of outcomes remains wide. Upcoming releases on payrolls and core inflation, alongside Fed communication, will be critical for judging whether this dovish repricing still has room or is already ahead of itself. Within equities, leadership is gradually broadening beyond the dominant U.S. megacap technology names. In the United States, small-cap stocks have been quietly outperforming large caps for much of the past year, helped by the perception that policy rates have peaked and that the next significant move is more likely to be lower. Recent weaker payrolls have supported rallies in small caps and fresh highs in benchmarks such as the Dow, as fears of imminent tightening fade. At the same time, interest is building in healthcare and consumer staples, which trade near historically low valuation levels and offer potential diversification away from richly valued AI and memory chip leaders. Outside the U.S., Europe has stepped into the spotlight. European equities, led by the Stoxx 600, have outperformed the S&P 500 year-to-date, and recent gains are no longer confined to financials and industrials. Utilities are currently the best-performing sector in Europe, signaling a defensive tilt, while basic resources and technology are benefiting from a weaker dollar and firmer precious metal prices. That performance comes with political caveats. France faces a difficult mix of election uncertainty and fiscal strain, with concerns that populist outcomes could widen government bond spreads and complicate efforts to bring the deficit under control. In the UK, debates over fiscal space and potential reforms to business rates, including higher taxes on large logistics warehouses used by firms like Amazon, create a shifting landscape for listed retailers, logistics operators, and domestic cyclicals. In Asia, South Korea is emerging as another bright spot. The Kospi has been posting strong gains despite bouts of volatility, and the move to 24-hour trading in the Korean won marks a further step toward deeper, more liquid markets aimed at international investors. When combined with relatively attractive valuations in many non-U.S. indices, this points to a world where equity leadership is becoming more geographically diverse, but where country-specific policy and political risk are increasingly important performance drivers. The AI investment cycle remains a central pillar of the equity story. U.S. corporates are seeing strong profit growth, helped by AI-related capital expenditure, supportive fiscal deficits, and solid exports, yet the sustainability of the most crowded AI trades is coming under closer scrutiny. Capital is flowing beyond U.S. hyperscalers into global data centers and memory producers, with South Korea again at the core. Talk of a potential collaboration between Anthropic and Samsung has added momentum to Korean tech rallies, and Asian trading has seen tech-led gains supported by optimism around new product pipelines, including in healthcare-linked technology. Even so, recent sharp swings in semiconductor stocks highlight how sensitive the sector is to small shifts in AI demand expectations. Equity valuations in AI-exposed names look increasingly exuberant, while corporate credit spreads in those same sectors remain elevated compared with the broader market. Bond investors appear less convinced that the capex boom will translate seamlessly into durable free cash flow. There is also a growing concern that major cloud and platform companies are evolving from highly cash-generative businesses into more capital-intensive, cash-consumptive models. That raises questions about balance sheet capacity and the cost of capital into the second half. In the UK, proposals to shift business rate burdens toward data centers and large warehouses could further pressure the economics of AI infrastructure in that market. In parallel, private credit is flashing its own risk signals. Funds with heavy retail distribution, including vehicles managed by Ares, Apollo, and Blue Owl, face elevated redemption requests, with more than $14 billion of investor capital now gated. Gating clauses and staggered exit windows are containing foreselling, and performance has so far remained resilient, particularly for diversified managers such as Oaktree and Goldman Sachs. Nevertheless, concerns are building around a looming refinancing wall over the next 2 to 3 years, especially for shorter-dated corporate loans. For equities, the combination of aggressive AI capex, stretched valuations, and simmering private credit liquidity risk forms a single cluster to watch, where any shift in credit conditions could quickly feed back into growth expectations and multiples. Geopolitics and the energy transition add another layer of complexity to the equity outlook. Tensions involving the United States, Iran, and Israel around the Strait of Hormuz have already delivered a small shock, with earlier disruptions pushing oil prices higher, trimming growth, and temporarily lifting inflation before a recent stabilization eased those pressures, particularly for Europe. Even as conditions calm, the cost structure of global trade is shifting. Transit fees in the Strait increasingly look like a permanent feature, and major Gulf exporters such as Saudi Arabia and the United Arab Emirates are investing in alternative shipping routes through the Red Sea and ports like Fujairah. That rewiring of supply chains supports long-term demand for logistics and energy infrastructure, but also embeds a persistent geopolitical risk premium. Climate and resource security are reinforcing these themes. Europe's record heat waves and mounting water stress are accelerating investment plans in recycling, desalination, and more resilient infrastructure, including local bioenergy such as biomethane and projects to secure strategic minerals. Utilities have already emerged as Europe's best-performing sector, reflecting both this infrastructure pipeline and a defensive bid. However, policy uncertainty around subsidies, regulation, and long-term targets remains a critical swing factor for equity valuations across renewables, grids, transportation, and even aerospace, where companies like Airbus still face significant execution and supply chain risks to meet ambitious delivery goals. The strategic message is that infrastructure, energy, and defense-linked themes enjoy strong structural tailwinds, but realized returns are likely to depend as much on regulatory clarity and project execution as on headline spending plans. Stepping back, global equities are leaning toward a constructive soft landing narrative. Softer U.S. payrolls, a more benign inflation backdrop, and reduced expectations for near-term Fed tightening are all supporting a risk-on tone, even as central banks keep stressing their commitment to price stability. Leadership is rotating gradually away from an ultra-narrow group of U.S. tech giants towards small caps, cheaper defensives such as healthcare and staples, and non-U.S. markets including Europe and South Korea. At the same time, the AI and private credit complex is emerging as the main pressure point, with exuberant equity valuations sitting alongside more cautious signals from credit spreads and gated fund flows. From here, the balance of risks hinges on three forces: incoming labor and inflation data, how aggressively corporates continue to spend on AI and infrastructure, and whether political and geopolitical shocks, from French fiscal debates to the Strait of Hormuz, stay contained. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.